All right, good morning, Checkmate crew. It's 30 minutes after the opening bell of the New York Stock Exchange, 10 a.m. Eastern Time on this Tuesday, January 10th, 2023. Yours truly, Mickey Blindside here with your market memo. Okay, guys, today, or I should say on Friday, at the end of last week, we saw a huge rally in the S&P 500. I think it was over a 2%er day, right? Yeah, it was over 2% that day. We also saw initially on Monday, we had a huge move to the upside, but then it retraced and actually closed negative for the day. Actually, I think it was a little bit less than 3 points. The S&P 500 closed minus 0.08%. But at the same time, the VIX was up 4%. So we're still seeing that outsized VIX moves to the upside in comparison to a smaller drawdown in the S&P 500. And we've been talking about this since summertime, that if we saw this toward the end of the year, beginning of 2023, or the end of 2022, that we might see this rolling bull market, this mini bull market that might last a few months, come out of that. And so right now the thesis is still playing out. There's still a few more weeks that I think where we need to see the VIX really go up and see that long-term hedging. And that long-term hedging is going to fuel the grinding rally that could happen in the next few months. And so that's that thesis still is playing out. So we'll see what happens around that third week of January after the monthly options expiration. A bulk of the tax selling that happened in December, it will have been 31 days after that. Although there has been there was some tax selling in the beginning of December. Remember when we saw oil and semis sell off at the same time? That was actually beginning of December, but most of the tax selling actually happened around mid-December, the bulk of it. But actually, we're already seeing institutional bid coming back in the semiconductor space. And again, this one started tax selling in the beginning of December, so their 30 days was up this week. And so we're actually seeing the semiconductors have more strength in the market than some other areas of the market. Again, I said that a rolling bull market is a low correlation bull market. So we're already seeing signs of that happening now, okay? But the bulk of the buying, I don't think is going to happen until we get later on in January. And then after that, we could see even bigger institutional demand come back around, let's say, around March or so. After there's a little bit, I think there's going to be some long-term tax selling and profit taking in some of the industrial names. And so we might see some rotation out of those industrial names into tech names. So we might even see tech rally a little bit more and even show some strength this year. Very possible, because again, a lot of these names, like industrial names like Caterpillar, for example, a lot of the block trades for buying actually happen around the end of February, early March, okay? End of February, let's say. So for institutional investors who want to take profit, it makes sense for them to wait until after a year when they purchase this, so that they can be taxed at the lower capital gains tax rate rather than income tax rate, okay? And that's like a 30-40% difference. And so, if your rate of return benchmark, is 30-40% higher, of course, your bonus is going to be higher. And so for fund managers, really, it's all about keeping your job and maxing out your bonus. And so they are incentivized to hold on to that position at least for a year, so that they can get taxed at the lower tax rate. So I don't think we're going to see selling in some of these industrial names until after the 1 year mark happens. And then lo and behold, at the end of February, early March, watch, some of these industrial names are probably going to sell off. And if it happens, I think, and also too, at the same time, the 10-year Treasury rate, the TNX, if that 10-year Treasury yield also comes down at the same time, that money that got sold, those proceeds from those sales of those industrial stocks are going to need to find a home. Well, if interest rates are coming down and people are seeing that there is an uptrend in the market, well, what do you think they're going to put it in? Okay, they're probably going to go with growth. So we might see them putting some money into QQQ or QQQ stocks and tech stocks, semis. Already we're seeing buying happening in the semis. So I am willing to, at this point, if we see a big enough dip, I'm willing to buy the dip on the QQQ and actually IWM as well. IWM is super strong as an index right now. And so, if the IWM or the QQQ pulls back, I'm buying the dip, okay? Of course, I'm only going to be buying this dip if liquidity conditions still keep improving, okay, as they are right now. So let's take a look at actually our liquidity and market internal data. So here is the New York high-low line. So, they takes the New York Stock Exchange stocks and it measures how many stocks are making 52-week highs versus how many stocks are making 52-week lows. And, if more highs are being made than lows, the number gets added to this line. If there are more lows than highs, that number gets subtracted from this line, that difference, okay? And so that makes a cumulative line right here, okay? Now, this is one of the indicators that we use to see if a rally is going to have sustaining power or not. Generally, what we want to see is that this rises up and gets above all three of our moving averages. That's the 29 and 4 exponential moving averages. We actually all year, actually since I believe November, December of 2021, we have not seen the New York high-low line go over the 20-day exponential moving average. We just haven't seen that yet, and it's really hard for the market to sustain a multi-month rally unless the New York high-low line is curving up and over all three moving averages. Okay, it's just, and I looked through this since the 60s. Okay. Not personally. I wasn't around then. I'm not old enough to be around in the 60s. But I looked at the data from the 60s, and so since then, it's really hard to sustain any type of meaningful rally unless this is curving up. If this is in an uptrend, we're not in an uptrend yet. It needs to make a higher high and a higher low and be over all of these moving averages. That would be a very, very high quality signal from the New York high-low line. Also, if we look at the New York advanced decline line, so this is the New York Stock Exchange advanced decline line, we're actually seeing more advances over declines happening in the stock market. If this is trending up, very, very positive for small cap stocks. And so that's why I'm right now, when we're buying the dip on the indices, I'm leaning toward tech or small cap, more so in the small cap than tech. But I think both will do very, very well. I might do maybe half and half on both. And this is the reason why. When the New York AD line, when the advanced decline line of the New York Stock Exchange, when there's more advances than declines in the New York Stock Exchange, that's a great sign that there's a lot of participation in the market. Generally, that means there's strength, relative strength in the Russell 2000. All right. That's the New York AD line. If you also look at the equal weighted S&P 500, we're also seeing that there is some strength in this as well too. And so, it very much mimics the S&P 500 right now, which means that when the S&P 500 is rallying, it's not just the mega cap tech stocks that are rallying, but it's also across the board. And so that means that market breadth is quite, or at least it's not weakening. It's stronger than it is weaker. Okay. So that's the market internal. So again, the market internal liquidity data still has to be in an uptrend. All right. That means the New York high-low line. Oh, and also our junk bonds advanced decline line. Okay. Our junk bonds advanced decline line is curving up, guys. We're actually only about like 40 plus 41 away from our December highs. So as you notice, we've been in a downtrend in our junk bonds ADL line, advanced decline line on the junk bonds market, since November, December of 2021. All right. We've been making, lower lows, lower highs, and then all of a sudden now it looks like At the end of December, early January, we made a higher low. And I think it's very possible that we could get to a higher high situation. Now, we're only 41 away from making a higher high over the December highs, okay? Which means we would need a positive reading today and a one that's not, close to flat. And if you look at the past, past 10 to 20 days, the average has been around 300 or so, plus minus 300. Okay, so the junk bonds ADL line moves up and down 300, or on average, up and down about 300 a day. So if we end up with an up day in the junk bonds advanced decline line, we could be seeing a higher high situation. So that makes things very interesting. Okay, that would imply that there is some liquidity entering into the junk bonds market, and generally it trickles. Once the junk bonds market starts getting a bid, you start seeing the stock market getting a bid too, because the junk bonds is the junkiest part of the bond market, and the bond market is way bigger. I mean, it's like a huge freight cargo ship versus a tugboat, okay? The stock market is more like a little tugboat. It's like the little brother, and the bond market is like this huge tanker / bigger brother, and little brother always follows big brother. Generally, that is the case. Not always, but generally that is the case. If there is a disagreement between the two markets, the bond market usually wins, okay? So we're not seeing any disagreements between the two markets, but we are seeing the junk bonds advanced decline line improving. Now, if our liquidity data keeps improving, junk bonds ADL keeps going up, makes that higher high, higher low, it makes an uptrend. Also, New York high low line also makes an uptrend. Then on the next major pullback, I'm going to start buying the indices, okay? That would be a buying signal. And I'd be buying at this area right here, about 171.50, let's say between 170.50 and 171.50 on IWM, and then on QQQ, I'm looking for a pullback to around that 267, 266 zone. And again, as we see that liquidity data improving, if we see a pullback, boom, I'm going to be buying, okay? I'm going to be using options, most likely some leaps. 1 to 2 years out. It depends on the implied volatility at the time of that pullback, but I'm going to be buying some in-the-money leaps. I might even buy some in-the-money leaps and some out-the-money leaps, just so I can also get a little bit what is it? This coming Thursday, we got the US CPI coming out. There is an expectation that inflation will come out lower than expected. What a surprise, right? I mean, you guys know this, but here at Checkmate Trading, we've been expecting that since the summer. We called it in the summer that in November, December area, we were going to see a possibility of a lower than expected print, and now everybody is expecting that. So go figure, right? We stay ahead of the curve, but there is a chance that we're going to see a lower CPI print, but I think it's already pretty much baked in. What the market's reaction will be, I have no idea. It could be buy the rumor, sell the news kind of an event, where even though the inflation comes out lower than expected, the market sells off because that expectation was already baked in. We just don't know that, okay? And so, you never know what's going to happen, but right now TLT is in that range, that when it topped off right here back in, when it did this, we said that, most likely in 6 to 7 months, we'll probably see CPI drop off. Remember guys, this is when the inflation protected treasuries it was the last auction where it was over 9%, and they got a huge retail bid for about a month before that subscription deadline. And so we saw this. I think this is more of an anomaly, but I think we're going to mostly stay in this box until planting season, and then we might see commodity prices go up, and then we might see this inflation indicator go up. And again, this is our inflation protected treasury ETF divided by long-term treasury ETF. All right. And so when it's trending up, it means that the bond market is looking toward a higher inflationary period ahead, where if it's trending down, it means that the bond market is anticipating a disinflationary period ahead, okay? So I do think we're going to resume the uptrend at some point, probably later this year. Of course, I think it's going to be very dependent on when this commodity cycle starts again. And I think that's going to happen in around planting season. Not trying to predict the future. I'm just trying to anticipate, 5 or 6 moves ahead what could be, okay? So anyway, Thursday we got that, and the US CPI probably coming out lower than expected. Friday also kickstarts the earnings season for Q4 2022. Q4 2022 earnings start getting released. Always the big banks started off. JP Morgan, Citibank, these big banks, they're the ones that set off the earnings season. Usually right before earnings seasons, we see XLF, which is the banking ETF. We see XLF go up. I have no idea if it has not. Oh, yeah, it did. Look at that. Yeah, usually about a week or two beforehand, we start seeing a rally in XLF. It happens about 70 to 80% of the time. I don't know why it does, but it just does, okay? And we'll see if it continues or not, but that's pretty compelling right here. If it does get to this point, maybe this is a short. With improving liquidity, it's really hard to short. You don't really get as much much meat out of it on shorts when liquidity data, internal data is improving. But it looks pretty compelling, though. I might just stay out of this, to be honest. So that's XLF. So again, earnings season is going to start. We might see earnings revisions for 2023. If earnings revisions do change, let's say it gets higher, okay? If earnings get revised higher, and at the same time the 10-year Treasury yield drops, we could see the stock market rallying. From that, we could see a big risk on sentiment, especially in tech. Okay, especially in tech. We're not there yet. The earnings estimates for 2023 probably won't be revised for another 2 to 4 weeks until some of these big tech names report earnings. Tech names are slated to report earnings later this month. Usually it's the financials first, and then about 2 weeks after that, that's when the bulk of the tech stocks will report earnings. So we got about 2 to 4 weeks until that earnings revision happens, which conveniently also coincides with when that bulk of the tax selling 30-day wash rule period ends. So we've got tech earnings then. We've got January OpEx then, options expiration. We also have that 30 days after bulk of that tax selling after the wash sale rule period. So a lot of things are coinciding on that week, that third, fourth week of January. A lot of things are going to happen, and I think it's going to be a pretty explosive period. This quarter is we're going to probably see some really big moves this quarter. From end of January all the way to March, I believe. We're going to be constantly in action, I think. It's going to be an active quarter, I think. So it should be good. It should be good for us. For at least, for my process, it should be pretty good. So I'm looking forward to a good quarter and an active quarter ahead. All right. What else? Oh, by the way, we talked about earnings and all this and tech and whatnot, but let's also talk about China for a bit here. It's funny, the sell side operations for Goldman Sachs, JP Morgan, all these big banks, they're all of a sudden getting very, very bullish on China after China does a 40% move upwards. Now they want to get bullish on China. Go figure. We started getting bullish more around here, about a week or two. At end of October, we noticed this. Remember, guys, when I talk about China, what do I always talk about? You guessed it, Australian dollar. The Australian dollar, AUDUSD. Yeah, the Australian dollar, remember, it bottomed out, and we saw an exhaustion signal in the mid of October. And we saw it trending upward by the end of October. And remember, I said, this looks like it could be the bottom for the Hang Seng Index and for China. And lo and behold, what happened? 2 weeks later, we got the low in the Hang Seng, okay? And it's gone up 40% since then. And now the big banks want you to get bullish. Of course, it's their sell side operation. So, I guess, it's for the sell side clients. And so, Of course, they want to get bullish now, but I think there's still more room to the upside. If the Australian dollar keeps going up, we could see this, trending up. I do want to see a pullback. Going long here, I think is chasing it. And again, you guys know what I want to get involved with, the ZTO. Remember when it had earnings, I said, oh, if ZTO gets to under 20, we're going to buy. And I think it was only like less than $1 away from that. But I mean, it is what it is. It is what it is. We missed that train. Should have chased it right then and there here when I talked about it in mid-November, but I don't chase. It's just one of my rules. I've been doing this too long, and chasing, although it can work at times, it can also lead you into disaster. So I just tend not to chase. But those who did chase probably end up made a pretty penny on this. So good for you guys. That's what I see in China right now. All of a sudden, institutions are, the institutional bid actually came here, all right, much lower. Institutions were actually buying China in October right here, all right. So definitely it's late, late in the game for these big banks to be recommending their clients to buy, but it is what it is. But I thought I'd share that with you guys. Again, Australian dollar, that's going to be our signal. I do think the Australian dollar is going to pull back a little bit. And if it pulls back, as long as it holds over that 640, on the weekly chart, as long as it holds that, it still remains in a weekly uptrend. And as long as the weekly uptrend is sustained on the Australian dollar, we could see an uptrend in Chinese stocks. So that I'm just waiting on this pullback, and we shall see. We shall see what happens. Oh, by the way, I also opened up some new positions as well. Not really new positions, but I just sold some covered calls on some of the positions we had. So SBLK, remember SBLK, Starbulk. I sold some covered calls on this on Friday, a little bit too soon. It is what it is. So we do have the January 2025 18 calls. I did sell some of these 21 strike calls for February against them. And so, right now that would, if Starbulk keeps going up over 21, so, the January 2025 leaps are for the 18 strike, and I paid 3 for them. So my break even happens at 21. And so if it busts over 21 by February, I think I collected about 45 cents per contract on the February covered calls. So then I'll be forced to take a minimum profit of about 15%. So my profits will be capped at 15% if this thing just keeps going up all the way over 21%. I don't think it's going to go in a straight line. I do think that we see a pullback. So I'm hoping that I do get an opportunity to close out my covered calls so that I can participate in the next rally with just some long naked leaps. But we'll see. I do have a poor man's covered call already, a position for SBLK. Also for Quad U, our uranium name. I also sold on Friday some covered calls, also on half my position on Friday, and then half my position at the highs, top tick yesterday, which, I guess it's pretty lucky. So right now my average covered call cost basis on the 7 strike calls is about 35 cents of credit per contract. So hopefully I'll be able to reduce my cost basis on the shares that I have. Right now, I believe my cost basis on my shares right now is an average of about $6.07. And right now we're at $6.55. So we're in a little bit of a profit. Hopefully I'll be able to get a bulk of that 35-cent covered call premium. If I could close it out at around 15 cents, that will mean that I netted about 20 cents of credit. That brings my cost basis down to about 587, and then we can wait for the next pop to sell covered calls and just keep bringing that cost basis down. My goal is to make the cost basis on all of my long-term leaps and also my shares as close to free as possible. That's my favorite, my mistake, so that you guys can learn. as well too. And it also helps me too. It also helps me to analyze, and be really strict on myself on my own mistakes. And that's how we grow as traders. So I do thank you guys for joining me. It does help me as well too with my own discipline. So that's Quad U. That's the new positions. That's the new covered calls that we wrote. Crypto right now, the open interest on crypto's options are still low, although it is rising a bit. It's not where it needs to be for me to keep tracking it. It's not where it needs to be for me to track it to see where I think price could get pushed or pulled by the options market. However, I will note this. Over the weekend, last week, we had a breakout over our zone of interest here. This is the last time where we went long, and this is where we managed risk. Unfortunately, we got stopped out at break even when that whole FTX fiasco broke out. But now it looks like it broke out of that level, back tested it, and now it's running away from us. So look at that, guys. It looks like crypto's coming back. I'd like to see what actually happens in this uptrend line. And this uptrend line is something that I calculated from back in 2020. Okay, it's anchored to the trend line for 2020 to 2021. From the 2020 COVID lows, it's the uptrend all the way up to 2021. Okay, that uptrend line has been very valuable. It's been a very good place where we saw institutional demand. Even when 3AC fell back in the summertime, that's where we actually saw a big demand for ETH come in. We also saw around this time the open interest on ETH options start increasing over here too, in preparation for the merge in September. Okay, so this is a very good value zone right here. This I think this line right here, this upward trending line, it is a line of interest for me. And again, I didn't eyeball this. It was actually calculated using values and transaction zones back in 2020 and 2021. So I'm not eyeballing these lines, and I get it. Diagonal lines on a chart. It's kind of cringy, but I think if you are able to anchor those lines on certain transaction zones, you can get a pretty good trend line out of that. And I do use it very sparingly. I have very strict rules when it comes to diagonal lines, but I think this would be very interesting if it goes up to here and then from here it slows down and retests this again. That would be very interesting. Now, if that happens, okay, if it happens where this touches this line right here and we fall from there, and if we retest this 1241.46, I would be willing to go long again on ETH at 1241.46. But again, the progression would have to be a higher high. So it would have to touch this green line. If it touches this green line or goes a little bit above that, that would create that higher high. It would create a higher high and a higher low. And right on that first touch of that 1241.46, that's when I would go long. Now, we would set our stop probably around here, around that one, a little bit under, let's say, 1175. Under 1175, that would create a lower low. Would that create a lower low? Hold on. Let me see. Yes, under 1180, actually, it would create a lower low on the weekly chart. So that is where we can set our stop. And so that creates a situation where we're only on the hook for about 5%, but the upside is way more. It puts the reward to risk in our favor. So I'm willing to do that, okay? I'm willing to go and do that and risk 5% on that because the gains could be quite good, and the reward to risk makes a lot of sense. So again, it needs to touch this line right here, creates a higher high, boom, comes back down, hits 1241.46, it bottoms out at 1241.46. That's when I'll go long, and then we manage risk under 1175 would be my stop, and then we let it ride, okay? And then we just keep bringing up that stop. As the market, as if this gets into an uptrend, we just keep raising that stop. We'll set a trailing stop on that, so that we can protect our profits. Okay, that's my plan for Ethereum. Anything else, guys, you want to look at? Going once, going twice. All right, then in that case, that wraps up our session of the morning market memo. Our Discord invitation link is in the video description below. Come join our Discord, be a part of our growing community. There's no sub fees, no paywalls. It's of the people, by the people, for the people. And if you enjoyed our video, hit like, follow, subscribe, comment, show us some love, baby. All right, I'll be back on tomorrow and Thursday, 30 minutes after the opening bell of New York Stock Exchange, 10 a.m. Eastern time. Hope to see you guys then. Trade safe.